And that should be the same as the square root of 1 minus 1% minus 1. By the way, this is not exactly minus 0.5%. This is rounded number, right? So the because of the square root, so our return here on the previous page was minus 1%. So it's not just half of that, right? So I don't have a more accurate number here on my notes. So again, the log returns are much more simple. So the arithmetic average is basically just the simple average of the two, right? You add up the returns, you divide by the number of years that you have. And now this becomes really simple because we have the 10% minus the 10% divided by 2. So if the 2-year return is 0, then the average of that is also going to be 0. Maybe one note kind of on how this is tackled or how this is done in practice. So typically returns are measured on a daily basis. And now you could think, okay, so there are 365 days in a year, but it's a little bit more complicated than that because on weekends usually there is no trading and we have public holidays. So the average number of days where you actually observe returns per year is 252 days. That's kind of the standard that's used in practice. Right? And then you take the 252 divided by 12, and you should end up with 22 trading days per month. Right? These are averages, of course, and there might be months where you have more trading days, like December. No, December is probably a bad example because of the Christmas break, but October. And there might be days, months with fewer trading days, like February, for example, which usually has a smaller number of days, calendar. So every market that you can trade in they have their standards and conventions of how you count days. In the stock market, you basically do work with the 252 trading days per year. In the bond market, it becomes even more difficult because now you actually do get interest on weekends. However, if you will count days exactly per month, again, it becomes very difficult because you have to think about, okay, which month do I have? Like, how many calendar days do I have per month? So one standard, for example, that can be applied is that every month is just basically assumed to have 30 days. It doesn't matter how long the month is actually. You would just assume 30 days per month. And that means that a year then has 360 days, right? Again, it's not perfect, but it's a simplification that's maybe justified. So in every market, for government bonds, for example, or for derivatives, you have a certain convention how you count days. And there are so many different variations that we can't mention them all. So I just want to make you aware that you have to know basically how to do this. In our class, this one won't really come up. The annualization that I just mentioned, using from daily to annual, that would be something that we can practice a little bit. But besides that, we're just expressing time in fractions of years, and we'll stop at that point, right? We don't really worry about how many days are in January, February, and so on. But that is an important detail in practice. In the bond market, there's not a lot of things happening, so there's not a lot of movement compared to the stock market, but there's usually large amounts of money involved. So the bond market is larger than the equity market. We've seen that last week. Right? So in that sense, it can make a big difference of how many days you get your interest. Even small numbers or small differences in these computations can have a large impact in euros that you end up on your bank account at the end of the day. So these are the typical computations that you do. You do basically compounding of multiple returns to either multiplicative or additive. And the second one is the annualization, That's what we have done here. So basically that's computing either geometric or arithmetic averages. Yeah. Maybe a final note on these two averages here. So actually, you want to kind of memorize a little bit, or what's the difference between the two and when you should apply them. You can actually kind of mirror this a little bit with trading strategies. So how do I achieve the geometric average as a return when I want to do trading? So the idea is you have maybe a starting amount of money, say 100 euros. You invest the 100 euros in this example for 2 years. And at the end, you end up with 99 euros. And your average return over those 2 years will be minus 105%. Right? So you keep your money invested in the market. You don't remove anything after the first year. So the geometric average is the one that actually most investors should use who have a long-term strategy. Right? If you want to, for example, look at what's my long-term return I get in the stock market, people falsely use the arithmetic average to compute that. It's not the correct number. You should use the geometric average because you will keep your money invested for a long period of time. And that's mirroring the trading strategy. So the geometric average is the one that you should actually use to compute long-term averages in the stock market. The long-term average is, by the way, 8% in Germany, right? If you want to invest in the German stock market index DAX. That's the long-term geometric average over the last 50 or so years. The arithmetic average is a different strategy. So how do I actually get the returns from the arithmetic average? And the idea here is to do something slightly different, and that is basically doing a reset after the first year. So again, you start off with 100 euros, and the first year you earn 10% on this, so your profit is plus 10. Now, but instead of keeping the 110 invested, you remove the profit from your account. So that at the beginning of the second year, you invest the same amount as before, so you start over with 100. Then in the second year, you lose 10% of now 100, right? So you lose 10. If you go 10 up, 10 down, you end up with 0. Right? So the arithmetic average is a strategy where you invest the same amount of money every period. Right? So this is something that investors typically don't do, right? So you don't withdraw all your profits at the end of the year, or if you make a loss, you don't kind of put money on your bank account to lift it to the initial capital level. Right? So, but that's the idea behind basically getting the arithmetic average through a trading strategy. Okay. The first one is geometric average, money invested, you don't remove anything. And the second strategy would be at the beginning of every period, you do a reset that you start off with the same amount of invested capital. Why is that relevant? So, as I mentioned, you should look at the geometric average, but if you compare the two numbers, in terms of magnitude, the arithmetic average is actually usually higher than the geometric average, just in terms of the numbers. If you try a couple of scenarios, you will always realize that, I think you can actually prove this, that the arithmetic average is always larger than the geometric average for any combination of numbers. So suppose now you're a bank and you want to sell your fancy financial product, right? Which of the two numbers do you pick? Right? Of course you pick the one that's higher, right? So the number that banks and fund managers are telling you is this number because it makes them look better. Right? But the number that you can realize through a normal strategy would be this number, right? So they're telling you, or they're misleading you in the sense that they're showing you something that artificially looks a little bit better. Right? So whenever you're talking to a bank advisor about long-term investment strategies, ask for the geometric average. That's the correct number to look at. Okay, so these are the basic rules that you need to know, and I hope that you see from the log returns that at least they have some benefit since we just add up the numbers. That's an easy way. See, I do have my retake exams in parallel, so that's why I have to look on my phone from time to time if there's a problem. Okay, so there are no questions. Maybe we move on. We have, let's do these 3 more slides and then we do a break after, before we start the new chapter. So we've talked about stocks as a representative for the equity category. and about stock returns. Now let's look at bonds. So B is the abbreviation for bonds. Typically, we assume that we have the same rate for investing and borrowing money, so we don't really make a difference. Again, it's not realistic, but we want to start off simple, right? We can make it more complicated later on by having different rates and implementing them. Right? So it's not changing our theory if we do that. So for the class here, we basically have the same rate for borrowing and investing.